Supermicro jumped 10.6%. Lab scores at 46 out of 100. Hold. Its industry-leading direct liquid cooling platform now supports 100 kilowatt rack densities for Nvidia's Blackwell GPUs. That 100 kilowatt density gives Supermicro the only clear first-mover advantage in the Blackwell rollout. In the full teardown, we break down how that cooling edge translates into margin upside. SMCI is up 10.6% because their 100 kilowatt, a unit of power, rack density lead is the current AI bottleneck. Supermicro's hardware position is a fragile speed advantage rather than a structural moat, as legacy competitors are already matching their thermal management specs. While the move to $33.91 reflects high utilization for Blackwell NVL72 architectures, the physical limit is CoWoS, chip-on-wafer-on-substrate, the packaging technology that stacks dies, where SMCI has zero pricing power. We are seeing a Tier 2 beneficiary rally that ignores the looming parity with Dell's liquid cooling solutions. 10.6% surge is a relief rally on order volume, but it ignores the engineering reality that speed to market is a decaying asset. Quarterly financials showing modest revenue momentum for Supermicro. By Q4 2026, renewed tariff uncertainty will compress Supermicro's gross margins by at least 200 basis points, hundredths of a percentage point, as the hardware supply chain braces for a trade war. While the Fed holds rates at 3.63%, the normalizing yield curve, the relationship between short and long-term interest rates, signals a shift from easy AI capital to disciplined capex. With an 8% recession risk, the market is no longer pricing in infinite growth. The lab is tracking the 30.1% revenue jump at TSMC as the primary accelerator, but SMCI sits in the crosshairs of export controls on Blackwell GPUs to China. This geopolitical friction is a headwind that even 122% revenue growth can outrun. Supermicro reported earnings per share of $0.84, beating the Wall Street estimate of $0.63 by 32.3%. A solid beat that signals strong execution. Supermicro, server integration, is trading below its 20-day average. SMCI just ripped 10.5%, and management's PR machine is working overtime with one phrase: diversified customer base driving better margins. That's the headline. What they want you to feel: stability, growth, margin expansion. What they don't want you to think about: the $7 billion equity raise that diluted shareholders by 12%. Or the fact that insiders haven't bought a single share in 90 days, zero conviction at the top. The lab hears the silence. EPS beat by 32%? Great. But R&D as a percent of revenue is shrinking, down 40 basis points QoQ. That's not a growth signal. That's a margin protection play. And while analysts keep raising targets, ARK trimmed its position. The bid is thinning. Watch the next 10Q for one line. Inventory turns below 8x. The momentum breakdown for Supermicro. RSI sits at 34, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Supermicro's lead in direct liquid cooling for Nvidia's Blackwell ramp provides a critical first-mover advantage as rack densities hit 100 kilowatts. However, the 16.5% short float, the percentage of shares bet against the stock, signals massive skepticism regarding margin sustainability as Dell and HPE catch up. Can SMCI maintain its speed premium if hyperscalers shift to direct ODM, original design manufacturer, sourcing? The lab says no. Standardized clusters will eventually commoditize these custom racks. Our hold call at $30.33 captured this 11.8% move, but conviction remains low. If SMCI holds 15% margins in Q3 2026, we target $50.17. If they dip below 12%, expect $27.78. Our AI score of 46 to 100 reflects this tactical uncertainty. Here's the macro picture shaping Supermicro. Strict U.S. export controls on advanced silicon limit SMCI's ability to ship high-performance liquid-cooled racks containing Nvidia H200 or Blackwell GPUs to Chinese hyperscalers and sovereign clouds. Additionally, geopolitical instability in Taiwan threatens the critical supply chain of SMCI's primary motherboard and subsystem fabrication partners, exposing the company to severe production bottlenecks if cross-strait tensions escalate. The massive industry transition toward liquid-cooled AI data centers directly drives SMCI's current volume shipments of its custom direct liquid cooling technology optimized for Nvidia GB200 NVL72 architectures. As memory bandwidth demands surge, SMCI is rapidly integrating high-bandwidth memory and advanced packaging architectures into its modular server designs to support next-generation AI accelerators. The primary near-term upside catalyst for SMCI is the rapid production ramp and delivery of their liquid-cooled Blackwell-based server architectures to major Tier 1 cloud service providers. Conversely, the most critical downside risk stems from persistent gross margin pressure and potential market share loss as legacy server competitors aggressively discount their own competing AI hardware. SMCI's hold rating reflects a stable revenue outlook amid tight margins. Is the hold signal on SMCI a conviction move, or do you see a better entry ahead? Comment below. Remember, this is educational content, not investment advice. You should conduct your own due diligence, and past performance is no guarantee of future results. We analyze data objectively, but market conditions can shift quickly, and any trading decisions rest entirely with you. Subscribe now for deeper engineering insights on semiconductor stocks. If you want our full breakdown on Intel, the link is in the description. Stay sharp, and see you next time.